Hello everyone. In this video I'm going to cover chapter 11 of the financial accounting course that has to do with stockholders' equity and trading capital. In this chapter or this lecture will include several conceptual ideas and other applied ideas or maybe accounting ideas or concepts. So I'll try to explain what we are learning in theory or concept and how we apply those in accounting terms. So how you see them on the balance sheet or in the income statement or the statement of cash flows. So to begin with, what is stockholders' equity? It's the major source of resources for corporations. So when you start up a company, you have assets and owner's equity, and then you borrow some funds from the bank or from creditors so that you have liabilities. But at the very beginning, you have assets is equal to owner's equity before raising any liabilities. Then when you have some liabilities, when you raise some debt, when you have some debt, you end up with this equation. So owner's equity, which is our chapter, is the major source of resources, which is the initial contribution of investors. Stockholders' equity comes from two primary sources: the original contributions of stockholders and the company's accumulated earnings. So under owner's equity, we have two things, as you remember. The capital stock, which is the initial contribution of stockholders or investors, and we have retained earnings, which is the accumulation of profits over time. Some advantages of having a corporation versus a company. As you know by now, that a corporation is it constitutes a specific number of stocks or shares, and anyone can buy this stock or share as long as someone else is willing to sell it. And this is the corporation. As for the company, it can be held privately by one person or a group of individuals, like a sole proprietorship or a partnership, and so on. So corporations, which is the cornerstone of this lecture or this chapter, it has some advantages and of course disadvantages. Some of the advantages that stockholders, people who own these stocks, are not personally liable for the debts of the corporation. So if the company goes bankrupt and the company gets liquidated to pay back the creditors, if the liquidation of the company does not suffice or offset in full the debts or the creditors' rights, the creditors cannot go to the people who own those stocks and own their cars or their houses, so that it cannot get personal. It's the liability is limited up to the level of ownership in this company, the assets of this company. This is one of the main advantages of corporations. Another advantage is the transferability of ownership. So I can own 100 shares in Apple today, and tomorrow I can sell them to Sam. So now I'm no more an owner in Apple. Someone else has become an owner in Apple. Moreover, on the advantages of having corporations is the professional management. So this is versus the family business, for example. A professional management doesn't include any, nepotism, any corruption, hopefully. So the manager that is assigned by the investors or the shareholders, or maybe elected by the shareholders through the board of directors, I'll explain this later on. This manager will perform at some level, and this performance will be evaluated. So it's a professional thing. There is no free lunch. There is a penalty for bad performance, and there is a reward for good performance. Also on the advantages, the continuity of existence. So if the establisher of the company dies, this establisher owns some stocks in this company, and those stocks will go to other people, and the company will continue. So the death of the founder or the owner or the main owner of the company does not mean that the company is dead or died or ended. So in simple terms, the ownership will remain to exist, and will be transferred to someone else. Some disadvantages of corporations is the heavy taxation that in some cases it might reach 40%, which is a very high percentage that goes to the government. I'm saying 40% from the net income, which is a lot of money. If you make $1,000 in profit, you will get 600 and the government will get 400. So this is a big amount. Greater regulation, for example, in the United States, the body that regulates corporations is called the Securities and Exchange Commissions, the SEC, and they have very tough regulations on companies because those companies have the money or the investments of the public. When you purchase a stock, you are investing. The public is investing, all people, the public is all people, is investing their money in the company or the corporation. So the corporation is held responsible for the funds of the public. Therefore, there should be a very firm and tough regulation from the government. The governmental body that regulates corporations or the behavior of corporations is called the Securities and Exchange Commissions in the United States. Also, on the disadvantages, it's costly to form a corporation. You don't simply decide to form a corporation and that's it. There are several regulations that should apply or standards that should apply. Finally, the last disadvantage of forming a corporation is the separation between ownership and management. And there's a long-standing literature on the separation between the ownership and management, where later on, hopefully when you advance in your studies, you will reach the agency theory, where basically the agent, the agency theory, you don't know, I'm telling you. The agency theory is basically a conflict between some guy who's called the principal, or basically the owner, and the agent who is hired by the owner, and this is the manager. This conflict between those two, the owner and the manager, is called the agency theory, and basically this conflict arises when the manager is managing the resources of the principal or the owner in not necessarily the best way that serves the benefit of the principal. So maybe the manager is trying to benefit privately from managing the resources of this principal or owner. This is just for your information. You will not be examined with this material. This is a very diverse material that we can discuss for hours and hours, maybe days. A logical question arises here: why businesses incorporate? Why don't they stay as companies, private companies? Like, I always give you the same example, like Spinneys. It's a very successful business in our country, and it is still a private company, and they're doing fine. Why would they incorporate? One of the reasons is that when they incorporate, it becomes a limited shareholder liability. So now if Spinneys defaults on a bank payment, the bank can go to the owner of Spinneys and sue them and maybe claim their houses. But when it's an incorporation, they cannot do this. Also, another advantage is the transferability of ownership. So maybe Spinneys today decides to incorporate, and the price at time 0 is for one stock is $10. And they know that after a while, given that they are successful, after 3 years, so at P3, this price might become $150. So now if they sell half of their shares in the company, they will make a fortune. So over 3 years, they have made 150%, right? In return, I mean. Okay, one more reason for incorporating that's not mentioned here, you can raise funds from the public. So you can issue new stocks. And when we say issue new stocks, I'm meaning sell new stocks to the public in order to raise funds. When we say raise funds, we are meaning we're getting more money, and this money can go to expand your business. So assume that now Spinis, again the same example, Spinis is an incorporation and not a private company, and they decided that they want to operate in each and every city in Lebanon, but they don't have enough money. So what can they do? They can issue more stocks to the public, and the public, who I'm referring the public, any one of us, knows that this company is profitable and successful and they have a good management and they're performing really well. So it's tempting to invest today in Spinis by whatever amount of money, given that you are almost certain that after some time, this money that you have invested will grow and prosper and become even more. So you are willing to give your money to Spinis so that they invest it on your behalf in their business, and then you will make a lot of return, positive return. So this is another reason why businesses incorporate, so to raise more funds to expand their businesses. Stockholders. So stockholders are the owners of the company. Anyone who holds a stock is one owner of the company. Of course, owners own companies with different percentages. So if I own 1 share out of 1,000 shares, it means that I own 0.1% of the company. And if my friend owns 500 out of the 1,000 shares of the company, it means that he or she owns 50% of the company. But still, I'm called an owner, and my friend is also an owner, with different percentages, of course, of ownership. There are some rights for those stockholders or owners. We, as stockholders, we get to vote for directors and on other key issues. Such issues is like if you want to acquire another company. So I always give you the same example of Facebook and WhatsApp. When Facebook acquired WhatsApp, they go back to their shareholders and they make a voting. Do you want us? Do you think that this acquisition of WhatsApp is a profitable decision? And will it yield profits in the future? So we as owners, we get to vote. And this voting goes to the board of directors, who decides on our behalf. So it's like, if you think about it, it's like the parliament and the people. We, the owners, are the people. The board of directors are the parliament. We elect them, and they make decisions on our behalf. When we have a very critical issue in the country, we go to a referendum. So this referendum is like voting or asking the people for their opinion. Okay, another right for stockholders is when they participate in dividends declared by board of directors. So basically, when you own 3 stocks or 3 shares in whatever company A, you receive a specific amount of dividends per share. And this amount of dividends, again, as you know, it comes from net income. That goes in 2 ways. Net income is either retained inside the company as retained earnings or distributed proportionally over shareholders as dividends. So this amount, assume it's $100,000, is divided on the number of shares. As simple as that. Finally, upon liquidation of the company, you get a portion of the value that is liquidated. Assume that we have a company A, and it gets liquidated. The amount that after liquidation is $100,000. The first people who get their money are creditors, banks and bondholders, and so on. Then you go to shareholders, and you distribute the rest of the money on them proportionally. Okay, so board of directors, I gave you the example of the parliament and the people of the country. Board of directors is like the parliament. The functions that the board of directors may include setting corporate policies, protecting the interest of shareholders, ideally, hiring corporate officers, mainly corporate officers that really need the decision of the board of directors are the CEO, the chief executive officer, the big boss of the company, followed by the CFO, the chief financial officer. This guy knows a lot and usually is the right hand of this guy, and most of the times he's the successor of the CEO. Also, one of the functions held or the board of directors is responsible for is declaring dividends. They decide on the amount of dividends that they will pay, if any. Reviewing the findings of both internal auditors and independent auditors. So all public companies are obliged to have external auditors. So an auditor comes to your company and audits your bills, your supply chain, your manufacturing process, and everything. And they give you a report, and also you do the same on the internal level, so that you can spot whether those two contradict or not. And it's a better governance measure. So the board of directors review the findings of those parties or those teams, the internal auditors and the independent or external auditors. Okay, so as I mentioned, corporate officers, mainly the main ones are the CEO and the CFO. We have a set of corporate officers: chief marketing officer, chief accounting officer, several ones. But the main ones are those two. Okay, now upon formation of companies, the paperwork of forming a company, you need to specify, or the government maybe specifies, the number of shares that a corporation is authorized to issue. So when the company starts or gets incorporated, which means that it goes public from private to public, this company will sell the shares to the public. So the shares are now sold to the public. And of course, the public will give the company dollars, right? So let's say that this is the corporation that gives the public shares, and the public gives the corporation dollars. What's the benefit of buying shares from a corporation? We have two benefits. The public believes that, or individuals believe that the price of the share will increase, so we call it price appreciation, which is the opposite of depreciation from chapter 9. So we call it positive returns. And I assume that you all know how to compute a return. This is from grade 11 or 12. A return is equal to the new price, P1, minus P0, the old price, divided by the old price. Okay? So if the price was 80, which is the old, and it has become 100, so 100 minus 80 divided by 80, it means that the price has appreciated by 20 over 80, right? 2 over 8 is 25%, which is a remarkable increase. Okay. So the first source of benefit for the public is the price appreciation. The other source is dividends received per one share. Okay, so on top of increasing in price, you also receive dividends every quarter or every year. It depends on the corporate policy. Now, when the price increases, so it means that today you pay for the stock, let's say $10, and after a year, this stock is now worth $12. So if you have invested initially $1 million in the company, after a year, you can sell those stocks that were worth $1 million to $1,200,000, and therefore you've made a return of 20%. Throughout the year, you also receive dividends for those stocks. So this can be added to the return, which means that you've done really a good investment. Now, to get back to the incorporation and the low side of the whole story, this company is authorized to issue a specific number of shares. The company can be authorized to purchase, or to issue 1 million shares. And this is the maximum number that this company is allowed to issue. But in fact, they issue only 20,000 shares. Those shares are the authorized shares, and those shares are called outstanding. Outstanding shares means that those shares are owned by the public and they are outside the company. Okay? Those shares are shares that are trading now in the stock market. Outstanding shares trading in the stock market. Okay? So you need to differentiate between two things. The number of authorized number of shares that the company is authorized to issue is different from the outstanding shares that are currently outside the company trading in the public or in the stock market. This number, the 1 million shares, is just a number on the paper. It has nothing to do with the reality. This is just paperwork. You are authorized to issue this number. This doesn't mean that you will issue this number. And most of the cases, this number will be much higher than the outstanding number of shares. Okay? This is what I'm saying. Corporations normally obtain authorization for more shares than they initially plan to issue. Okay? Finally, shares that have been issued and are in the hands of stockholders are called outstanding shares. So outstanding shares are different from authorized shares. What we care about is the outstanding shares. Now, I just want to give a brief example about the structure of corporations. I'll do this by giving a simple example. Assume that you have ABC company or corporation. Corporation. Is authorized to issue 5 million shares. Upon incorporation, so when they started or when they got established or went public, incorporation, ABC issued 2 million shares at $10 each. Okay, so this is the initial price. you decided to buy 2 shares or 2 stocks. It's the same, 2 stocks in ABC. This means that you invested $20 in ABC. So you gave those $20 to ABC to operate them on your behalf. You're bearing the risk that they might fail in their job, and you will lose the $20 or some of the $20, and you might succeed, and those $20 will grow and grow and grow, and you will receive dividends and so on. Now, therefore, you own 2 over 2 million of the corporation. It means that your ownership percentage or portion is equal to 2 over 2 million, which is 0.0001% of ABC. Okay, so when we say that, for example, Bill Gates owns 5.1% of Microsoft, this is an extremely big number. This is a huge fortune of money. So this was just to motivate the concept of corporations and stocks on ownership percentages for you. I just gave you a realistic example in our country. There's a bank called Audi Bank. This bank, 35% of this bank is owned by Deutsche Bank, a huge German bank that decided to invest in Audi by 35% of its equity. So this is how things work. Deutsche Bank is called an institutional investor, and you, in this example, you are called an individual investor. So institutional investor, because Deutsche Bank is an institution, and you are an individual. Okay, again, some of what I'm saying is just general knowledge. You will not be examined with them. Now, I would like to move forward with how companies issue stocks, why do they issue stocks, when do they issue stocks, and what determines the price of this issuance. Okay, so initially the company goes public by an event called initial public offering. Of course, this initial public offering is an event. It has some rituals, not necessarily rituals, but it has some standards. They usually go to a conference room. They invite very wealthy people who might be interested in investing in such companies, and the founder or the main manager or the CEO of the company, which is still a private company so far, it hasn't become a private company. This CEO or the founder of the company goes and try to convince the audience, who are wealthy people or investors, to convince them to buy their stocks. As much as this CEO or founder is able to convince them, as much as the starting price is higher. So the first time this happens is called an initial public offering, or IPO, after which the company becomes public. So it's no more a private company. It's no more private, and the company will have a stock that can be traded on the stock market or in the stock market. Stock market. So now you can, for example, type on Google stock price of Apple. Today it's trading at $276. So each share in Apple is worth $276. So this is the selling price, not the selling, let me call it the stock price of Apple. Okay. When the IPO took place for Apple, maybe the starting price was, or the initial price of the shares in the market was as small as $6. You never know. Maybe it was. I'm curious to know now. So the initial public offering has a starting price. If the company succeeds, the stock price will skyrocket. And therefore, those who took the risk initially by investing in a new company now has become wealthy people because they own stocks that are worth millions and billions of dollars. Now, what I want to say that after a few years of operations, of course, the company will be preparing their financial statements every month or every quarter or every year. And maybe this company, ABC company or corporation, has a tempting investment opportunity. So they have the opportunity to invest in other company or in other project that looks tempting. So the return is expected to be high. When you have this opportunity, you need to fund it. However, ABC company or corporation is short on cash. So their internally generated cash is not that much. And it's not enough to invest in this new project. And they are trying to avoid borrowing from banks or creditors like bondholders. Therefore, ABC will refuge to its stockholders. So what happens in this case, which means that the company or the corporation will issue a new set, or maybe I can call it, or wave of stocks to the public. Now, to the public, this public might be an existing investor, so someone who already owns a share in ABC, or a new investor that, he just heard of the company. So now, who determines what is the, or who determines what the price of the new issue is? What happens here, the investors have some expectations about this company. So if the company is raising funds so that they invest in a new project and they have a good history of performance and they are not suffering financial distress, then the issuing price will be very close to the price that is trading in the stock market. So assume that in the stock market now, the ABC company has a stock trading at $47. The selling price of this new issue per share, of course, will be somewhere around $47. However, if the company is suffering financial distress and they are raising funds to pay their creditors, then the issuing price will be too low because none of the existing investors nor the potential investors or new investors are willing to pay their money or invest their money in a company that is shaky. You never know whether this company will continue its year, for example. So what I want to say here, what determines the price of the share that was issued by ABC is investors' expectations. Investors' expectations. Those expectations have two main paths, 1 and 2. If ABC has a good investment opportunity and a promising future with a credible history, then the issue price will be close to the trading price in the stock market. However, on the other hand, if ABC suffers financial distress or difficulties, and when we say financial distress or difficulties, it means that this company is not being able to meet its financial obligations. So if the company suffers financial distress, none, or let me say no one, would be interested to buy their shares, and therefore there is a very low demand and the selling price or the issue price will be too low. Okay. What I discussed now is for the concepts that you need to understand from this chapter. They are not the accounting side, merely the accounting side, but you need to understand them. You cannot study stockholders' equity without understanding these concepts. Now, so this is just to recap what I explained in the last 3 slides. The issuance of capital stock, the price that a corporation will seek for a new issue of stocks. So when we say new issue of stocks, it's any issue after the IPO or after the initial public offering. New issues. We call them, just for your knowledge, seasoned equity offerings, or SEO. So IPO is only once at the very beginning, and then SEOs can take place every other year, every 5 years, every 10 years, depending on the need. So the price that a corporation will seek from a new issue of stock or an SEO, in other words, is based on factors such as expected future earnings and dividends. So if the company is doing well and the expected future earnings and dividends meet the expectations, at least, of the investors, then the price will be a good price, the issue price. The financial strength of the company, if the company has been doing well so far and it's financially healthy, then also the price will be close to the trading price. And the current state of the investment market, if the whole market is not doing well, for example, in the 2008 meltdown of the economy, no one will be willing to give their money to companies. All companies, all the investment market was in a recession or melting down, and no one would be interested in putting their money or bearing that risk. So this is a macroeconomic factor. So these three factors determine the selling price of the new issued stocks. Now, par value, mainly par value is the stated value on paper. The stated value on paper, just like the authorization or the number of shares the company is authorized to issue. So this is something on paper. It's the minimum okay, here you go. It's the minimum value that the stock cannot go below. So you might have a par value of $2, still you issue your stock at $10. Okay, so this is called capital stock, which is based on the par value, and the difference, which is the $8, are called additional paid in capital. Okay, so capital stock is based on the par, additional paid in capital is anything above par. Now, we'll start with the accounting side of the chapter. The example says, when par value stock is issued, the capital stock account is credited. Of course, we know that capital stock or owner's equity in general increases by credit. So the capital stock account, which is based on the par value, is credited, regardless of whether the issuance price is more or less than par. Normally, it shouldn't be less than par, and you will not see this. So usually it's higher than par. When stock is sold for more than par, the capital stock account is credited with the par value of the issues, and this is what I said, and the additional amount on top of the par is called additional paid in capital. So additional paid in capital and capital stock, two accounts for owner's equity. One is based on par and one is based on the excess above par. Now, for example, our 10,000 shares were issued at a price of $8 per share, and the given says that the par value of the stock is $2. Now, the easy part is cash. The company will receive from shareholders and new shareholders a cash amount that amounts to $8 multiplied by 10,000 shares. Okay, so $80,000 in cash, out of which 2 multiplied by 10,000 are the par value of those stocks, and this is the capital stock. Anything in excess, which is obviously 80 minus 20, is called additional paid in capital, or you will see from now on APIC, additional paid in capital, just for abbreviation. Just like we had in chapter 7, the allowance for doubtful accounts as AFDA, the same concept here applies. Additional paid in capital stands for additional paid, APIC stands for additional paid in capital. Now, your balance sheet under the stockholders' equity section, you will see that capital stock, the details are $2 par value, authorized to issue 50,000 shares. Outstanding out of those 50,000 is 10,000. So 2 multiplied by 10,000, which are outstanding, is 20,000. We don't care about the 40,000 that remained in the company. They are still inside the company. They are just, it's a piece of paper. It's nothing. It doesn't have a value so far. Up until it becomes an outstanding share, it will have a value then. So now the value of the capital stock outstanding at par, which is the capital stock, is $2 multiplied by 10,000 shares, and this will give us a $20,000. Additional paid in capital, we know the value from the previous slide, which is $60,000, or simply difference between the cash received, or proceeds, we call them proceeds, and the par value. So the total paid in capital is $80,000. Add to that the accumulation of profits over time, which is retained earnings, which is the $150,000, and you get the total stockholders' equity of $230,000. That comprises equity and retained earnings. Okay? Or stocks mainly, let me call it stock equity. Okay. Some stock do not have a par or do not have a minimum. Honestly, this is no big deal. Forget about that. Some stocks simply do not have a minimum value. So everything that you sell to your investors, all the stocks, the proceeds in full will be credited to the capital stock account. So you don't have an additional paid in capital in such cases. Okay, you don't have APIC because everything will go to the capital stock account. But in the chapter, we will not see such examples. Most of the vast majority of the examples will be on a par basis. There is no par stock. Types of stocks. Now, owner's equity, they have two main parts of stocks. The regular type, and let me call the other one the exotic. This is not an accounting term, but just to let it get to get it stuck in your to let it stick in your minds. The regular one is called common stock, and this is the regular issue, and usually it's the majority of stocks. Majority of stocks issued by the company. The exotic type of stocks is called preferred stock. So this is something common and this is something preferred, regular and exotic. Preferred stock. This preferred stock has some preferences or privileges over common stock. Some of them, they receive dividends first. This is one of the advantages. Another advantage is upon liquidation, after paying creditors, those people get their money before those people. Okay, just like a business class and an economy class when you travel. So I just wanted to explain those. We have one more type of stocks that doesn't belong to those. And this happens when the company decides to repurchase from the public its own stocks. So some companies, when they want to downsize, they want to shrink in value or in size actually, they repurchase from the public their own stocks. So those outstanding shares, when they are repurchased back to the company, they are called treasury stocks. Okay, so all you need to know now that treasury stocks are outstanding shares that have been repurchased and sent back to the company. Okay. Now, so again, I covered these. Common stock is the basic type of capital stock issued by every corporation. They have voting rights, unlike preferred stock, who cannot vote. They participate in dividends, and they have a claim to assets in the event of liquidation. However, they receive their claims at the very end. Preferred stocks, they have preference over common stocks when it comes to dividends. Some of them have the right to accumulate dividends, and this means that if you have, for example, year 1, 2, 3, and you committed to the preferred stock to pay them $100 every year per share. Okay, this is just an example. So you paid in year 1, in year 2 you didn't pay anything. In year 3 you will have to pay $200 to compensate for year 2. Those are dividends. Okay, so some of them have cumulative dividend rights, in which unpaid dividends, so if the company cannot pay its preferred stockholders this year, they will carry forward to future periods. So as if the company now is liable to those preferred stockholders. Preferred stocks have preference over common stocks as to assets in the event of liquidation. I mentioned this before. They cannot vote. They have a call feature, so the company can call their stocks back. So they have the right to oblige the preferred stockholder to repurchase their own stocks back. If you think about it, why would a company want to keep paying on dividends and committing to shareholders? So they will call it back, and I don't want to pay you any more dividends. Initially, they've done that because preferred stock are more expensive than common stocks, and therefore they can raise more money by issuing preferred stocks instead of common stocks. So in the balance sheet on the balance sheet in the stockholders' equity section, you will see, for example, we start with preferred stock, 9% cumulative preferred stock, $100 par value. This percentage is the annual dividend payment as a percentage from par. It means that each stock, preferred stock, receives how much? 9% of the $100. It's a $9 thing. So, and it's cumulative. It carries forward. If it's not paid in year 1, in year 2 you will pay $18 per stock and not 9 only. So authorized to issue 100,000 shares, and the outstanding are 50,000 shares. So the total value of under capital stock for preferred stocks is 100, which is the par, multiplied by 50,000 shares. And this is a $5 million. Also under capital stock, common stock, $5 par value, authorized 3 million shares, and they only issued 2 million shares out of the 3. So this 10 million is basically the 2 million shares multiplied by the $5 par value. Additional paid in capital, we have $500,000 for the preferred stocks, and for the common stock, it's $20 million. So the total paid in capital for preferred and common is $35,500,000. Add to that retained earnings, $17,500. In total, stockholders' equity is $53 million. Those numbers that we've been discussing in this slide are all given. So I just want to remind you that under stockholders' equity, owner's equity, we have three things now. The first thing is capital stock. And this is preferred and common at par value. The other thing is the additional paid in capital, also preferred and common, anything above par or excess. And finally, we have retained earnings. Okay, so capital stock at par, APIC, anything above par or excess or in excess, and finally the retained earnings. Now, you know what is dividends. We've explained this several times since chapter 3. It's paid in cash, and the company commits to pay it as long as it announces it. Cumulative preferred stock, as we said, that they carry forward from year to year. If the company doesn't pay dividends in year 1, and the declared dividend was, let's say, in total $12,000 in total for all stocks, for all preferred stock, and in year 2 they have to pay another $12,000, so here they did not pay it, they will pay the $12,000 for year 2, and they will have something like a liability for dividends. It's called dividends in arrears. As if dividends are queuing, you know, queuing when you stand in the queue waiting your turn. So the dividends in arrears are also $12,000 that came from the previous year. And for this year, year 2 itself, there is also $12,000. So dividends in arrears must be paid in a subsequent year or the following year before any dividend can be paid to common stockholders. Okay? Now, an example, cumulative versus non-cumulative. Assume that a corporation is organized on Jan 1, 2016, the beginning of 2016, with 10,000 shares, $8 preferred stock, and 50,000 shares of common stock. If the preferred stock is non-cumulative, the $8 per share dividend does not carry forward from if it's not paid in each year. So if the preferred stock is non-cumulative, this $8, it's either paid or not paid in a specific year. The next year is a new year. It's not affected by the preceding year or the previous year. If the preferred stock is cumulative, the $8 dividends per share dividend carries forward to future years if it is not paid in the current year. So in year 2, you will have to pay for year 2 and year 1, given that in year 1 you did not pay. The accumulated amount, which is dividend in arrears, must be paid before any dividend can be paid to common stock. And this is, again, a privilege for preferred stocks, and this is why it's usually it has a higher price. So this is the example when you have a non-cumulative option for dividends and when you have a cumulative option in dividends. Dividends paid in 3 years, and whether you have dividends in arrears or not. When you have a non-cumulative preferred stock, you don't even have dividends in arrears. So they simply paid $80,000 in 2016, and this value is basically the $8 multiplied by the 10,000 outstanding shares, and this was given in the previous slide. In year 2, they paid only $20,000, which is basically $2 out of the 8 per share. In year 3, in 2018, they paid nothing. They are not liable to those shareholders, the preferred shareholders, because it's a non-cumulative stock. So there is no dividends in arrears. It doesn't apply. If the stock is cumulative, however, in the first year they paid everything, so you don't have any liabilities. It's not a liability, but I'm just using the term to make it easier for you. In the next year, they paid 20. They should have paid 80. So they are liable. Again, it's not a liability. They are liable to the company, or they owe their preferred stockholders by 60,000. In the third year, they paid nothing. So they owe them those 60 and 80 from here. So this number, the 140, is equal to the 60K from 2017 and the 80K from 2018. Dividends in arrears are not included in the liabilities on a corporation's balance sheet. They are disclosed in footnotes of the financial statements. This is an example of a footnote that talks about or mentions dividends in arrears. You just understand the concept, and I don't think you will be examined with that, with how to write a footnote, I mean. Now, the primary sources of corporate equity, after all, you know that you have preferred stock, you have common stock, and you have retained earnings. This one has capital, stock, and APIC. This one also has both, and this one is an accumulation of net income or profits. Now, stocks usually have two values: a value on paper and a value trading in the market, which is the trading price of the stock. The book value is basically the owner's equity value divided by the number of shares outstanding. Okay? When we say owner's equity, we exclude from the computation preferred stocks and any other dividends in arrears. We will get to this in details. And you will get a specific number. Let's say $8 per share. The market value per share is simply the selling price or the trading price or the stock price in the stock exchange or stock market. And let me call it nothing, never mind. So it's the stock price. So MV, market value, or book value. Let's assume this is equal to $10. When the stock is trading above its book value, and when we say book, this is value on paper in the financial statements, in the balance sheet. And this is the value determined by investors due to demand and supply. When the market value is greater than the book value, their ratio will be greater than 1. So the market value is greater than value. It means that investors believe that the stock or the company, the company's value is greater than what the balance sheet shows. If the market value to the book value is less than 1, that means that investors believe that the company's value is overstated in the balance sheet. And this is something bad. The financial manager's main purpose is to maximize this ratio. Okay? Again, this slide and what I explained in it is more a finance matter, but it's important to understand it for the chapter, for the conceptual background of the chapter, and for your own knowledge. So the book value, again, I said that the book value is total owner's equity divided by number of shares outstanding, assuming that the corporation has issued only common stocks. So if you have some of those preferred, you need to remove them from here and here. So it only has to do with common stocks. An example, assume that the corporation has 4,000 shares of common stock outstanding, and the shareholders' equity section of the balance sheet is as follows. You issued 4,000 common shares. Each one has a $1, each share has a $1 par value, so your common stock is $4,000. Additional paid in capital is $50,000. Add to that retained earnings, so your total shareholders' equity is $130. Divide this $130 by the number of shares outstanding, so 130K divided by 4K, you will get a $32.5. Now this is the book value per share. You need to compare this to the market value of each share, which is the price of the stock in the stock market or the exchange, the stock exchange. Book value, as we agreed that the book value of a share should not have, or should exclude the amount of preferred stocks. So it's only computed for common stocks. If the company has both preferred and common stocks, the computation of book value per share requires two steps. In the first step, the amount assigned to preferred stock and any dividends in arrears associated with those preferred stocks should be deducted from the total shareholders' equity. The remaining will be divided by the number of common shares outstanding. This is an illustration. $1 million, the value of preferred stock. Common stock, the capital stock of it, so the par value is $500,000. Additional paid in capital only applies for the common stock because in this case the preferred stock was issued at par. Now you need, so this is the total paid in capital, retained earnings $130,000. In order to compute the book value, you need to remove this value, right? So because of a weak cash position, the company has no dividends during the current year. As of December 31, dividends in arrears on the cumulative preferred stock total $80,000. All equity belongs to common stockholders except the $1 million par value and the $80,000 dividends in arrears. So now the book value of the share is equal to owner's equity minus the $1 million and the $80,000 dividends in arrears divided by the number of common shares. So exactly, so remove the $1 million preferred stocks, the $80,000 dividends in arrears, divide them by the 50,000 shares of common stocks outstanding, and you will get a $26 book value per one share. So this is the book value per a share or per share. In the statement of cash flows, all of these transactions appear in the financing activity section. You just need to keep this in mind. They are not operations, and of course they are not investments. The market value, I explained this substantially. It's the market price at which the share is trading in the exchange market or the stock market. The market price might differ substantially from the par value, of course, the original issue price, and from the current book value. Okay. So if the company is successful, then the stock price will increase dramatically over time. If the company is unsuccessful and the stockholders are not receiving dividends and the company is reporting losses, then they might not be even able to recover their original investment, and the company will eventually go bankrupt. The comparison of book value and market value, I explained the implication of having a market value to book value greater than 1 versus having a market value to book value less than 1. You can read these two cases if you are interested in knowing more, or basically paraphrasing what I said. Stock splits. What happens here is very simple. Assume that your stock is trading at $130, and for marketing purposes, you want to keep it below 100. So you go to the stock exchange, you tell them that as a company, I want to split my stocks into half. So you will announce a 2-for-1 stock split. The selling price of the stock will become 65, which is 130 divided by 2, and the number of shares outstanding will be multiplied by 2. So if you think about it, the market value of the company is still the same. The market value of the company is equal to the price of the stock multiplied by the number of common shares outstanding. Let's assume that you've done not 2-for-1. Let's take it another example, 4-for-1. So each stock now has become 4 stocks or 4 shares. So your number of common shares is multiplied by 4. At the same time, each one of those has become 4 shares. So the price will be divided by 4. 4 and 4, you got back to the same thing. Okay, so splitting stocks is basically increasing the number of shares outstanding, but decreasing their prices for some reason. I gave you one example that some companies would like to keep their stocks below $100 to keep them more tempting or more approachable by individual investors. Treasury stock, I explained what is a treasury stock and how you get treasury stocks. Treasury stocks are basically the shares of a corporation's own capital stock that are outstanding. So they have been issued before and later reacquired or repurchased by the issuing company. Okay, but they are still active, so they have not been cancelled or permanently retired. Okay, so when you repurchase from the existing outstanding shares, they become treasury stocks. Treasury shares may be held in the company. When you say treasury, think about it as a safe in the company. Okay, this is the safe, and this is the code thing, and this safe has the treasury stock inside it. Okay, so the company took it from the public, or not took it, they purchased it from the public and kept it in the treasury, in their safe inside the company. They will leave it for when they believe that the time is right to reissue it back to the public. Okay, as long as those stocks are still inside the company and they are active, they haven't been terminated or cancelled, they are called treasury stocks. Treasury stocks are not entitled to receive dividends, as if you put them in the freezer. They are frozen now. They do not vote, and but they share in assets upon dissolution of the company. Now, how to record treasury stocks? You need to keep in mind that a treasury stock is a contra equity account. So when treasury stocks increases, your owner's equity value decreases because you are decreasing the amount of outstanding shares. Okay, so it's a contra asset account, just like contra equity account, just like accumulated depreciation is a contra asset account. When accumulated depreciation increases, the value of the asset decreases. The same applies here. When the amount of treasury stock increases, the amount or the value of owner's equity decreases or declines. The example says, purchases of treasury stock are usually recorded by debiting treasury stock account. So when you want to increase your treasury stock, and we know that it's a contra equity account, so it increases by or behaves in the opposite direction to owner's equity, so it increases by debit. And this should be done at the cost, by the cost of the stock. For example, if Riley Corporation reacquires 1,600 shares from outstanding stocks that have $5 par value and a current price of $90 per share, we don't really care about the par value. We care about the price, because this is the amount that the investors will receive from the company to get back the company's stocks. So the amount of cash that the company will pay, again, remember that we always do the accounting transactions of the company, because individuals do not even have accounts or ledgers. So the cash will decline by $144,000, which is basically the $90 multiplied by 1,600. So this is the $144,000. And treasury stock will increase by $144,000. So now my owner's equity will show a lower value due to the increase in treasury stocks. You need to know that treasury stock account is debited for the cost of the shares. We've seen that. Treasury stock is a contra equity account. I mentioned this several times. The purchase of treasury stock is regarded as a reduction in shareholders' equity or stockholders' equity. When you purchase treasury stock, it means that your total owner's equity has declined. For this reason, treasury stock account appears in the balance sheet as a deduction, a negative value, in the shareholders' equity section. Treasury stocks are authorized and issued, but while they are held by the issuing company, they are not outstanding. Okay, as if we put them in the freezer. So on the balance sheet in the stockholders' equity section, you will see that you have a common stock, additional paid in capital for the common stock, you have retained earnings, and then you'll have a subtotal. Why it's a subtotal? Because you still have to deduct the value of treasury stock. Okay. Now, if you decide to reissue back some of the treasury stock, so as if you are issuing new stocks, but now they are not very new because they have been there outstanding before, so you take them from the freezer and you are reissuing them. So assume that out of the 1,600 treasury stocks that you have repurchased before, you are reissuing to the public 1,000 treasury shares. Now the reissuing price is $115. So the value of the stock has increased over time, and you thought that it's the right time to reissue 1,000 of the 1,600 treasury stocks at a higher price than the price that you repurchased them at. The entry to record the reissuance is, the first thing is cash, as usual. $115,000 is the cash that you received from shareholders. The value of treasury stock that will decrease and therefore will increase your outstanding shares is 90,000, which is the 90 multiplied by the 1,000. The difference is additional paid in capital for treasury stock. Always the excess will be APIC. So now the balance sheet in the owner's equity section, you have common stock and its additional paid-in capital. But now you can see that treasury stock has additional paid-in capital of $25,000, which is the difference between the $115,000 and the $90,000, which is the excess that you've made. Add to that retained earnings, you still have 600 shares of treasury stock that had a cost of $90 per one stock. So this should be deducted from your total owner's equity. Now assume that you decided to reissue the remaining 600, so you will have no more treasury stock. The remaining at a price of $75. So you will lose $15 per one treasury stock. In this case, your cash is this 45,000 is the 75 multiplied by 600 shares, and this is dollars. Your treasury stock will decline by 54, which is the 90, the initial cost, multiplied by the 600 shares. The difference is a reduction in APIC, or additional paid-in capital. When you debit, this is the first time we debit APIC, because this is the first time we make a loss. So you debit APIC by 9,000 shares. So now your equity increased by 54,000 because treasury stock decreased by this amount, and at the same time it decreased by 9,000. So this is a decline, this is a reduction in equity, and this is an increase in equity. So now your equity has increased in total by 54, which is by 45,000, which is the 54 minus, so owner's equity increased by 54,000 minus the 9,000, which is a 45,000. At the same time, your assets increased by, in cash, by 45,000. So now the equality still holds. There shouldn't be a gain or a loss, no recognized gain or loss from treasury stock transactions, because you are not supposed to make a profit. So it's not a profit or a gain or a loss. It's simply an additional paid-in capital in the credit, which is something positive, or additional paid-in capital in the debit, which is something negative, because it's decreasing your owner's equity. Lastly, a couple of ratios that you need to keep in mind to measure performance. So ROA, return on assets, is the net income of the company divided by total assets, and ROE is the net income generated by the company divided by owner's equity. If you think about it, how much my assets are being able to generate in net income as a percentage, and how much my owner's equity is being able to generate a net income also as a percentage. Both measures, or both ratios, they measure performance or financial performance of the company. So ROA and ROE. This is the end of the chapter. I'll see you with a new chapter, and thank you for your attention.